the mortgage calculator. Today, we're going to be going over some live mortgage rates and doing a deep dive in conventional one-time construction loans. Excuse me, one-time close construction loans. We'll wait just a few minutes here to get started. Let us go live on all the different platforms. We are streaming this live on YouTube, Facebook, and LinkedIn. Feel free to drop a comment there as you tune in. We do have the chat pulled up on the screen. I see some comments already coming in. Thank you, Heather, Michael, Sandra, Ashley. Appreciate it. Warren, thank you for the comment. We will get started here in just a moment. Great topic here today. So hang tight. We'll get started shortly. And feel free to keep dropping comments there as you tune in. Thank you, Adam, Owen, Dario. Appreciate the comments. All right. Okay, it looks like we are live on all the different platforms, so feel free to keep dropping comments there as we go through, but we'll take the chat off the screen for now, and also drop any questions you have in the chat. So welcome everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We are a correspondent lender that specializes in non-QM loans. And what we do every morning here on this show is go through some live mortgage rates for some conventional FHA and some non-QM loans. Then after that, we do a deep dive into a different topic every day. Now, today's topic is going to be conventional one-time close construction loans. Definitely a unique product. And so our sales manager, Jose Gonzalez, with 28 years of experience as a loan officer and a realtor, is going to do a deep dive into that topic here later. But before we do that, let's do what we do every morning and pull up the actual live rate. So Nick, if you're ready, let's pull up our pricing tool and let's see what the market is looking like this morning. I'm assuming it's going to be interesting after yesterday. So let's check it out. All right, let me switch my screen and we get started here. All right, this is our pricing tool for our team here. This will show us the general rates and APR for today. It is September 21st. Fortunately, we had the announcement yesterday, which didn't necessarily go in our favor. So this may have a little bit of increase from yesterday. But if you'd like a full breakdown, a full loan estimate, please get with our team. We have over 400 licensed loan officers in 24 states for primary and secondary homes, and we can do our business purpose in 44 states. So let's set up a basic scenario so we can compare across the programs. We'll set a loan amount of $400,000. We'll set an LTV of 80% loan, 20% down payment. We'll set a desired price of $99. That means we're going to ask the computer to find the best rate at one discount point in cost. And we'll compare our programs. We'll check out conforming conventional first, then we'll check out FHA, and then we'll go into expanded guidelines, also known as non-QM. We also have VA and USDA. We've done a couple examples for those this week. Remember, VA is only for eligible vets and active service members. If you are eligible, let us know. We can quote it, no problem. And USDA is only for eligible properties. If you do happen to be shopping for one of those, just let us know. We'll start with conforming conventional as we do every day. We'll do a purchase, 30-year fixed, standard loan, primary occupancy, single-family home, 1 unit, state of Florida, county of Miami-Dade. For all the demos, we use an estimated FICO score of 760 and an estimated debt-to-income ratio of 40. So let's see what the Fed announcement has done to the markets this morning. All right. Well, a couple options went up. One option went down a tad. This is actually a little too expensive, though, but that's an interesting little fluke there. I would probably say these are more accurate, 7.5 rate for 0.875 discount points and costs, and a final APR of 7.662. So just a touch higher than it was yesterday. Just the Fed didn't raise the rates. However, the sentiment was not well received, and we did see the 10-year shoot through the roof yesterday afternoon after all those notes were released. So let's switch over to FHA and see how FHA has reacted here. We'll set up the same exact scenario. If our customer doesn't qualify for conventional for any reason, usually FHA is the next option here. It does allow a little more leniency on credit issues as well as a higher debt to income ratio limit. However, we'll keep everything exactly the same so we can compare directly across the programs. And these did go up a touch as well, as expected. 6.625 rate, 0.893 discount points in cost, puts the final APR at 7.214. So a little bit higher than it was yesterday because of the news there. But you see here, this option is definitely still a little bit cheaper than conventional. So our customers that qualify for both, definitely check out FHA. And our customers that must use FHA for the more leniency do get to take advantage of the reduced MI that they have implemented this year. Now, where we love to help our customers if they don't qualify for either conventional or FHA, many other banks or lenders have to deny that customer, but that's where we have over 5,000 additional options under expanded guidelines, also known as non-QM. So when we select non-QM, we now get a new option that pops up for income, where we can choose an alternate income. So full doc is 2 years of tax returns. That's what we use for FHA and conventional. So we would typically choose non-QM to take advantage of one of these other ones like asset related, business bank statement. Our investor programs are just for investment properties. Personal bank statement 12 months is what we use for the demo every day. We also have RSU, stated, VOE, 1099, P&L, and no income CDFI. But the most popular is our 12-month personal bank statement for our self-employed borrowers. Many times when they submit 2 years of tax returns, we'll have various write-offs and may not qualify at all, or may just not quite get enough income to get the home they really want. So we'll solve that problem for our borrower here in that case by using no tax returns, just their last 12 bank statements, to determine a debt to income ratio of 40% in this example, using just their cash in the bank, no tax returns at all. So many times our self-employed borrowers will get double or triple the income using this method and can therefore qualify where they would otherwise not. So let's check out the bank statement options. And as we say every day, the non-QM markets don't move as, I guess I would say, violently or quickly as the conventional and FHA. So you see here, it's about the same as yesterday, 7.5 rate, 2.75 discount points of cost, always a little more cost for non-QM. Puts our final APR at 7.625. So it's actually, I believe that's just a touch under conventional today for this option. And you see we have a ton of different options for bank statements. Some of these ones at higher rates and costs may allow things like foreclosures and bankruptcies and other items that would otherwise cause us to not qualify. So not only can we use alternative income, we can also get around other issues as well with a ton of different options here. So please get with our team. They'll find the best one for you. And we always want to do a couple live demos for investment properties. So we're going to do our final 2 demos here for investment properties. We'll set up the same exact scenario, 80 LTV, 20% down payment. And we'll compare our 2 options here. We have our conventional programs, and then we'll check out our non-QM options. Remember, government programs, FHA, VA, and USDA do not work for investments. So we'll simply check out these 2 options here. First, we'll start with conforming. Everything else is exactly the same. All we've done is change to investment. So let's see what the conforming conventional programs have added as an adjustment for investments. Again, I don't know what's up with this one showing up. I think one of these rates is screwed up. Obviously, this is not a legal rate like it was on the last one. So we're going to ignore this one. Someone's not updated yet. So this is the option that I would be looking at, 7.625 for 4.125 discount points and costs. That's already probably over the limit as well. Puts our final APR at 7.896. So definitely a little higher than it was yesterday. And as we say every day, unfortunately, with conventional, there is not really a higher rate option to reduce the discount points. Most investors ask us to find higher rates in order to reduce this 4.125 discount points, which is $16,500 in this example, so that they can save cash to invest in other investments. However, conventional has these limits, and as has happened when the rates go crazy over the last couple months, this is probably exceeds the legal limit anyway, so we probably wouldn't be able to offer this either. However, if we were able to, this would be the APR, so just to give us an example here. And typically our customers are going to ask for other options. So that's where Conventional isn't really feasible, especially today. So just as we have done for the last couple of years, we definitely recommend all our investors check out non-QM, expanded guidelines options, not only for the flexibility, but also because of the conventional pricing has been a little prohibitive here recently, especially today when the rates go a little bit crazy. So when we select an investment non-QM program, the first option we need to select is income type. So the most popular income type for an investment property is going to be our DSCR option. That's because it doesn't require any income or employment from our borrower. We simply use the estimated rental income from the property to determine a DSCR ratio. It stands for debt service coverage ratio. As long as the estimated rents can cover the PITIA of the mortgage expense, aka the property cash flows monthly, that's a ratio of 1.0 or higher. We even have options for ratios under 1.00 where the property doesn't quite cash flow on a monthly basis. For the demo, we always put 1.5 as the highest value. That way we can see all the options pop up. And the last thing we need to select is a prepayment penalty that is standard on investment property non-QM programs. So we always select 3 years as the standard. We can select 0 if we wish. That will obviously cost more and limit the amount of loan programs that show up. And we can also select 5 years, which will again limit the amount of loan programs that show up, but will save our customers some money when we do utilize those. Since 3 years is the most common, we want to use that so all the options show up here. So this did go up just a touch from yesterday. So DSCR best option here, 8.125 rate, 0.725 discount points in cost, puts our final APR at 8.182. So remember, conventional, if we could do it, probably wasn't compliant there on the cost. It was very expensive. However, the APR was 7.8 and change. Here, our DSCR options are within about 0.3 or less of the conventional options. So not only are the conventional options not feasible, but most of our investors, when they compare a DSCR or other non-QM option to the conventional, I'd say 90+% are going to choose the non-QM or DSCR option. So definitely recommend all our investors out there check out these programs. And you can see we have dozens of different versions of these programs. Some may allow, again, bankruptcies and foreclosures, which would otherwise cause us to not qualify. And some may allow, very popular requests these days, short-term rental income to be used for the DSCR. So tons of different options here. Please get with our team. They will find the best one. And now let's get into our cool demo today, where Jose is going to go over the conventional one-time close construction loan option. So we talked about the rehab options over the last couple of days. We talked about conventional. We talked about VA. We talked about USDA. FHA has a rehab option, but does not have a one-time close option. So we're talking about conventional, Fannie Freddie, one-time close, meaning buy land, build house, right? Before, remember the last couple of days, we're talking about rehab. That means you can't buy land. You have to buy a house. Even if it was burned to the ground, it had to be a house at one time with a foundation. Now, one-time close is the opposite, right? It can't have a foundation. We're talking about buying empty land and building a brand new home from scratch. So hopefully that helps introduce you there, Jose. But if you want to go ahead and take over and show us the demos, let's get started.
Good morning, everybody. Thank you for joining us on Daily Rates Live with the Mortgage Calculator. Continuing the theme with this week, we've been going over, first we had our USDA VA renovation loans, then we had our conventional renovation loans, and as Nick was mentioning, renovation loan is to renovate an existing structure, right? You cannot add additional foundation. You got to work with what you have. The one-time close is for the construction of your property. And the best thing about it is that the one-time close program also allows you to purchase the land in the same transaction. As we know, land purchases with financing are very difficult. The ultimate, basically the unicorn, is when you can get that nice land, build your dream home, and in the end, benefit from what you will probably have some immediate equity once you are done with your project because of the effort involved to build it, right? That there is, I guess you'd call that sweat equity almost, right? You're going through all the trouble of getting it done. So there is a lot of benefit to that. However, please note that the one time close program is not for spec homes. Right? It is not for building a home that you're going to sell right after you've completed the building. That would be a fixed flip loan, is what you would use for that, which is a short term bridge loan, not subject to any early payoff penalties, because that is an issue if you pay off any of these conventional loans in less than 12 months. There will be an issue that will be brought up called an EPO. The one time close program is also for primary and second homes only. It is not for investment properties. And as you will see in the examples I'm going to show you, there is a pretty drastic LTV reduction when you go to second home compared to primary. So, but that is one of the benefit. At least you can do a second home compared to the one-time close for agents. I mean, for FHA, USDA, and VA, which will be for primary homes only. So let me share some options with you here. The other big benefit of the one-time close program, just like the name implies, it is a one-time close. You are not going to incur additional closing costs transitioning out of your construction loan into your end loan. This is your end loan. Now, what you will note, rates are a little bit higher than what you're going to find with your standard agency loan, conventional loan. But you have to recall that this interest rate basically is being locked in for over a year while you're building the home, right? And then it transitions to your final end loan. So, and obviously there's additional risk that is involved just in building the home. What if you never finish? What if you run out of money? What if the project is mismanaged and the lender is left holding an 80% complete home that they would then have to complete at their own expense, or most likely just sell it as is and lose money on the transaction? So, here in this scenario, we have 95% LTV, which is the max LTV for this program, and a 12-month construction term, and you have 10.125 as your lowest cost option, 9.125 as your lowest rate option. So you see now when the construction term starts dropping, so here we have 9 months. So our rate does drop to 9.875 as our lowest cost option, 8.875 as our lowest rate option. And then we have a 6 month construction term. Rate gets even better, 9.5 as our lowest cost option, 8.5 as our lowest rate option. Now, these three options are for primary, right? Primary purchase, 95%. Now, for our second home purchase, in order to get compliant rates, we have to drop it down to 75% LTV. Now, the one thing I would say about compliant rates, it's mainly because we can't exceed the points and fees limit. However, if you are in a transaction, since this is a purchase where you can get seller paid closing costs, then if the seller pays those fees, they're not considered borrower paid fees, and then that would allow you to have a compliant rate. But in order to exceed 75% LTV, at 80% LTV, it was a cost of 4 points. You'd probably have to get at least 1 to 1.25% seller contribution to buyer closing costs directly applied to the loan discount in order to be able to go higher than 75%. So it is possible, it always is possible in any of these scenarios. If you get the seller to pay the loan discount points, then it's no issues with the compliance test, and then really no limit as much as the seller is willing to pay. But in this scenario, assuming no seller contribution, right? We are at 10.125 as our lowest cost option, 9.875 lowest rate option, and this is 75%. This is the 12-month term, second home. Then the 9-month term, again, drops to 9.875 with our lowest rate option, 9.625. And in our last example here, it is the 6-month term for the second home, and rates similar to the 6-month term at 95% for the primary. Here we have 9.5 as our lowest cost option and 9.25 as our lowest rate option.
All right. Well, I don't see any questions. Definitely a unique program there that a lot of people don't even know exists. So, something to take advantage of. And, like Jose says, in a tight market like it is right now, definitely something to consider for your clients or for yourself.
Right. The other thing that I could add is don't be dismayed by the rate being a little bit higher, because typically there is so much equity being built by the process of building your own home on your own piece of land that you selected, that really 6 months to let's say a year to 2 years down the road, you're going to refinance it. Rates are going to be much lower, and it's going to be considered a standard financing, and you're going to get super low rates. You're going to be able to get rid of the MI because you're going to have so much added value just because of how you ended up building the home.
All right. Well, remember, we do this 11 a.m. Eastern every weekday, and we do the live rates and then do a deep dive into a different topic. So we'll be back here tomorrow with a brand new topic. Thank you, everybody, for tuning in. Thank you, Nick. Thank you, Jose. And we will see you all tomorrow at 11 a.m. Eastern for the next episode of Daily Rates Live with the Mortgage Calculator. Have a great day, everyone.
Thanks, everybody.
Thank you, everybody.